Howdy, everybody. Welcome to Liberty Call. Today is Monday, June 24th, 2024. Hope you're having a fantastical day out there. It is beautiful here in Colorado. It's very hot, very, very warm. See what's the temperature right now outside. It is a balmy, it just says 84 right now on my little app on the bottom of the screen. So, but it is toasty in my house. Upstairs, hot. Down here, nice and cool at 70 degrees. Weird. Anyways, all right. Well, I hope you had a fantastical weekend. Astros swept the Orioles. I couldn't believe it. That might be their first sweep of a decent team all year. So anyways, all right. Well, they got the day off today. I got more meetings all week again this week. So if my schedule's a little off, I do apologize. And I think I got a few more next week going into the holiday. So anyways, well, if it is your first time watching Liberty Call, you could do me a favor. Give me some thumbs up. A like, a share, subscribe, a follow, and press the notification bell. Is it that hard? I mean, I say smart things 2 to 3 times a week, max. So you got to tune in every single day to see if I say anything smart. So, all right. Well, let's go ahead and get into the markets for today. Dow Jones was up 0.67%, 260 points, closed at 39,411. S&P 500 was down 0.31%, 17 points, closed at 54,47. NASDAQ down 1.07%, 188 points, closed at 17,500. So if I could pause here, this is kind of like one of the other days last week. It was like this, where the Dow was up and the S&P 500, the broader market, and the tech were in the red, where it's kind of been the opposite the last few weeks or even, kind of months, where, the Dow has been the laggard, kind of just, flatlining in the red, and we've had tech and, the broader market just going up like crazy. So anyways, the VIX was up 1.21% today. It's at 1336. Canada up 1.36%. Brazil up 1.07%. And Mexico down 0.6%. Western Europe, Germany was up 0.99%. The UK up 0.53%. France up 1.03%. Netherlands up 0.13%. Spain up 1.27%. Italy up 1.58%. Switzerland up 1.23%. And Portugal up 0.31%. Russian exchanges both red today. Both the MOEX and the RTSI were down 0.21%. And the overnights, the Nikkei in Japan was up 0.56%. Australia down 0.8%. New Zealand down 0.43%. In China, the Shanghai was down 1.17%. The Shenzhen Component down 1.55%. China A50 up 0.3%. DJ Shanghai down 1.2%. Hang Seng down 0.03%. And the Taiwan weighted, when it was last open on the 21st, was down 0.65%. Boy, a lot of good stuff there. All right, well, let's go ahead and move over next to the weekly update. Stocks edge higher over the 4 trading days last week, with 3 of the major averages taking turns leading based on various economic and artificial intelligence news. The Dow Jones Industrial Average rose 1.45%, its best week since May, while the S&P 500 index gained 0.61%. The NASDAQ composite, which has led all year, ended flat. The MSCI index tracking developed overseas markets rose 0.94% for the week through Thursday's close. Mixed economic news. All 3 averages began the week with gains, including new highs for the S&P 500. However, stocks posted only modest gains on Tuesday as mixed economic data came in. Retail sales rose 0.1%, less than expected, although better than in April when sales fell. Markets were closed for the Juneteenth holiday on Wednesday. As the week ended, it was the Dow's turn to lead as sentiment shifted on mega cap tech names as investors again questioned the sustainability of AI-driven markets. Home prices hit a new high in May. This, paired with high mortgage rates, caused existing home sales to fall for the 3rd consecutive month. All right. A notable AI driver. Some investors and market analysts are examining the underlying long-term drivers of AI more closely. Given its outsized impact on market averages like the S&P 500 and NASDAQ, one such underlying driver is DRAM, Dynamic Random Access Memory, the AI turbocharged version of a RAM semiconductor, more commonly referred to as memory chips. Companies making DRAM chips are essentially are an essential part of the AI ecosystem. Expect attention to shift to prominent DRAM players as they report earnings in Q2. Economic data coming out this week. Tuesday is consumer confidence and the Case-Shiller Home Price Index. Wednesday, new home sales. Thursday, gross domestic product, jobless claims, durable goods orders, and international trade in goods. Friday is personal income and outlays and consumer sentiment. A group or handful of companies reporting earnings this week. Tuesday is FedEx and Carnival. Wednesday is Micron Technology, Paychex, and General Mills. Thursday is Nike, McCormick and Company Incorporated, and Walgreens Boots. All right, so that is everything for the weekly update. Let's go and get to our market recap. Dow jumps amid broader market rally and countdown to inflation data. All right. Where's my notes? Here we are. All right. A broad stock market rally on Monday lifted the Dow Jones Industrial Average to a one-month high as investors shifted their focus from AI-linked stocks to other undervalued sectors, anticipating Federal Reserve interest rate cuts later in the year. NVIDIA led the decline in AI-related stocks, falling 5.4% for the third consecutive session due to profit-taking after its recent surge to become the world's most valuable company. Other semiconductor stocks, including Taiwan Semiconductor, Broadcom, and Marvell, and Qualcomm, dropped between 2.1% and 4%, contributing to a 2.3% decline in the chip stocks index. Jack Janasiewicz, lead strategist at Nataxis Investment Managers, noted that the market's rotation involves selling recent winners and buying laggards, influenced by expectations of softer inflation data due on Friday. Among the 11 S&P 500 sector indexes, technology and consumer discretionary were the only decliners, while the energy sector surged by 2.5%. The Dow gained over 0.5% intraday, marking a potential 5-day winning streak. The Russell 2000 small cap index also reached its highest level in over a week, indicating broader market strength. Phil Blancato, CEO of Ladenburg Thalmann Asset Management, suggested that softer inflation data could significantly broaden market gains beyond AI stocks. Investors are keenly awaiting Friday's personal consumption expenditures price index report, the Fed's preferred inflation measure, expected to show moderated price pressures. Market participants are pricing in a 61% chance of a 25 basis point rate cut in September, with the Fed projecting a likely rate cut in December. Other significant data this week includes durable goods orders, weekly jobless claims, final first quarter GDP figures, and the annual Russell Index reconstitution. Quarterly earnings reports and political events, such as the debate between President Joe Biden and Donald Trump in Atlanta, also could influence market outcomes. Meta Platforms saw a modest increase of 0.23% following reports of integrating its generative AI model into Apple's new AI system for iPhones, boosting Apple's shares by 0.77%. RXO surged over 21% on news of its plan to acquire United Parcel Service. Boy, that's something I hadn't heard in the news yet. United Parcel Services Coyote Logistics Unit for $1.025 billion. The New York Stock Exchange saw advancing issues outnumber decliners by 2.27 to 1 ratio, with 141 new highs and 39 new lows. The S&P 500 recorded 33 new 52-week highs and 1 new low, while the NASDAQ Composite saw 41 new highs and 101 new lows. All right. So everyone's excited that they think they're going to get a quarter point reduction in interest rates because, a 0.25% is going to save the economy. It is the one thing that is keeping us back from being just a juggernaut of an economy across the globe is that 0.25% of interest that the Fed is making you pay. Right. Okay. All right, next up, from our friends over at First Trust, Mr. Brian Westbury, Chief Economist. This week's article is titled, Lessons Not Learned. So let's see what Brian had to say. In the early days of COVID-19, the M2 measure of the money supply surged at an unprecedented rate in 2020 and 2021. Unlike the aftermath of the 2008-9 financial panic and Great Recession, this rapid increase in M2 signaled the high inflation that followed, despite many claiming that inflation was transitory, and that's in quotes. I remember Janet Yellen saying that, the dumbest human on the planet? Yeah. Over 4 years since COVID-19 began, inflation remains above pre-pandemic trends, with the consumer price index up 3.3% and core consumer prices up 3.4% from a year ago. Many economists, investors, and policymakers who ignored M2 were surprised by the inflation's persistence. Shocking. You would think that professional economists would realize that this was going to be a problem. I mean, me, just a amateur economist, I guess I would call it, someone who's read a lot of Austrian and listened to a ton of lectures and debates on Austrian theory versus Keynesian theory. And, what do I know? I'm just some moron sitting in the mountains. All right. Currently, a new conventional wisdom suggests that the U.S. is out of the woods regarding a potential recession. Yeah. I'll sell you a bridge if you believe that. This optimism supports a trailing price-to-earnings ratio of 24 on the S&P 500, historically associated with low future returns on equities, while hoping a recession doesn't occur. This is a concern that dismissive attitudes towards warning signs like the recent decline in M2 over the past 18 months could leave many unprepared for a downturn. May's housing data surprised many, with housing starts dropping 5.5%, completions falling 8.4%, and permits for future construction declining 3.8%. These figures are the lowest since the early days of COVID-19, despite elevated immigration levels. Immigrants don't have money to pay for houses. I mean, seriously. I mean, these people are walking across the border with everything they own in a bag. These figures are the lowest since the COVID-19. The lack of new housing raises questions about where newcomers, illegal immigrants, will live and the role of immigration in providing labor for home construction. Well, we have plenty of Americans who can swing hammers. They're just too lazy and not hungry enough to go out there and do it. Retail sales in May also underperformed, with a mere 0.1% gain for the month and revisions to prior months showing a 0.3% decline. This stagnation means consumers are buying fewer goods when adjusted for inflation. Car sales rose slightly in May, but remained down from December of 23 and June 23 levels. Additionally, the labor market shows early signs of trouble, and initial claims for unemployment insurance have increased, averaging about 240,000 in the past 2 weeks compared to 211,000 per week in late 23 and early 2024. While this could be a seasonal variation, it warrants close monitoring. Despite these concerns, industrial production has surged 0.9% in May, and the Atlanta Fed GDP model predicts 3% annualized growth for Q2, while another estimate tracks 2%. Private payrolls continue to grow, averaging over 200,000 jobs per month, albeit driven by part-time positions. Fiscal policy remains unusually loose, with high deficits despite low unemployment rates. However, the increasing interest burden on federal debt as a share of GDP suggests that using the budget to artificially boost growth may soon become untenable. Yeah, because the the interest on the debt is growing by $1 trillion every 90 to 100 days. So basically, over the course of a year, if they do nothing, it's going to grow at about $3 trillion a year. Let's see, where were we? In conclusion, while a recession is not guaranteed in the coming year, the risks should not be dismissed casually. Ignoring M2 has already cost investors, and continued vigilance is crucial. Yeah, I mean, if I was the American people, I wouldn't, or if the American people got mad and decided to go burn down the Federal Reserve and drag those people out and hang them from trees, I'm not going to stop them. All right, last up from article from Zero Hedge, there's no good reason to raise the inflation target. Remember, I've mentioned this a few times over the last few weeks, where the Fed is, talking about, since we can't get it down to 2, how about we just raise our target up? And, hey, now we're back on target. That's not how God, I gotta look at something in my eye, itchy. Anyways, it's like a eyelash or something. All right, let me get through this last one, then I can deal with it later. All right, where's my notes? Here we are. I may mess with it one more time. Oh, gosh. All right, I'll just look with one eye. It's okay. Alexander William Salter argues against raising the Federal Reserve's inflation target from 2 to 4% in his article via the American Institute for Economic Research. The Fed's current 2% target aims to maintain price stability and predictability, minimizing the risk of deflation. However, some economists believe a higher target would provide the Fed with more flexibility to ease policy during recessions. Salter contends this view is misguided, misunderstanding both monetary policy and the market price system. Proponents of a higher target argue it would allow the Fed more room to lower nominal interest rates, given the relationship between interest rates and inflation. According to the Fisher equation, nominal interest rates equal real interest rates plus anticipated inflation. Therefore, a higher inflation target would result in higher nominal rates, providing more room to cut rates during economic downturns. However, Salter argues that inflation itself does not benefit the economy and can be detrimental. Salter asserts that interest rates are a distraction from the Fed's primary task of boosting nominal spending, even if rates are near zero. Inflation, he explains, complicates the economy by introducing noise into the pricing progress and reducing productivity. High inflation rates create more variability in how monetary policy impacts supply and demand, weakening the market allocation process. Furthermore, inflation acts as a tax on holding cash and highly liquid assets, prompting market participants to engage in costly behaviors to avoid its effects. It also leads to more frequent contracting, increasing uncertainty and transaction costs. Additionally, in the U.S., capital gains taxes are not indexed for inflation, pushing investors into higher tax brackets and discouraging savings and investments, thereby hindering economic growth. Salter concludes that raising the Fed's inflation target lacks support from policy best practices and economic theory. He views it as a symptom of a broader misunderstanding within the economics profession and warns against adopting this misguided idea, emphasizing the need for credibility and predictable monetary policy to maintain economic stability. Yeah. Well, I mean, between the Fed and our government, they're determined to crash the economy and the dollar and everything else. I mean, there will probably come a point where, if some of the states decide to leave the republic and say, I'm out, I will probably go to one of those places. We're probably going to, whoever leaves is probably going to have to use a different currency. You can't trust the dollar at this point, whether it's, a crypto or something backed by gold or whatever it might be. I can't imagine that after going through this process and, having everything crumble, that, they're just going to go back to the same old with, where you have all the money printing and, where you have fractional reserve banking, which is, again, led to this issue. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All my contact information is there. If you need to get your financial crap together and get back on track for retirement or kids' college or, building that dream house or whatever it might be, give me a ring, shoot me an email. Be happy to get you back on track. All right. Well, that's everything I had for today. Like I said, I hope everyone has a wonderful evening, and I shall talk to you again next time. Adios.